Here is something that catches sole traders out more than anything else with making tax digital. The threshold is not based on your profit, it is based on your turnover, so you can have a perfectly modest profit and still be required to join from April 2026. Let me walk you through exactly who is affected, what counts, what changes, and what it actually costs you if you get it wrong. MTD for income tax rolls out in 3 phases. Over £50,000 qualifying income mandatory from April 6, 2026. Over $30,000 mandatory from April 6, 2027. Over $20,000 mandatory from April 6, 2028. HMRC works out which phase applies to you using your most recent self-assessment return. For the 2026 start date, that is your 2024/25 return, the one due by 31st of January 2026. If your income has grown since that return, the 2026 threshold will not catch you early. You get assessed again at the next phase. This is the part that trips people up the most. Qualifying income is your gross turnover, before any expenses, allowances, or costs. A sole trader turning over £60,000 with $35,000 in expenses has a profit of just $25,000, but their qualifying income is $60,000. That puts them in phase 1. Profit does not come into it at all. If you run more than one sole trade, HMRC adds them together. A web designer earning $32,000 and running a small shop earning $22,000 has combined qualifying income of $54,000. Neither business alone crosses the threshold. Combined, they do. And one more thing worth knowing. The £1,000 trading allowance does not reduce your qualifying income. It reduces your taxable profit. HMRC still looks at your gross turnover before that allowance when deciding if you are in scope. Once you are in, 3 things change immediately. You stop filing the old annual self-assessment return through HMRC's portal. You submit 4 quarterly updates instead, lighter touch summaries sent every 3 months rather than one big return. And you still complete one final declaration at year-end that finalizes your figures and confirms what you owe. So instead of 1 submission a year, you are looking at 5. For Phase 1, sole traders starting April 6, 2026, your first quarterly deadline is August 7, 2026. After that, deadlines fall roughly 1 month after each quarter ends. Miss one and you get a penalty point. Reach 4 points, and HMRC issues a £200 fixed penalty. Every late submission after that adds another $200. Here's the good news. HMRC is giving Phase 1 sole traders a penalty-free first year on quarterly updates. No points for lateness during 2026/27. Here's the catch. That soft landing does not cover your final declaration. That is still due January 31st, 2028, and being late there earns a point as normal. Digital record keeping is not optional once you are in. Every transaction needs the amount, the date, and a category, recorded digitally, close to when it happens. A spreadsheet you update once a month from memory will not cut it. But here is some reassurance. Your allowable expenses do not change at all. Office costs, travel, stock, professional fees, all exactly the same as under self-assessment. What changes is how often you log them, not what you can claim. So here's what to take away. Check your gross turnover, not your profit, against the threshold. Know your first deadline if you are Phase 1, that is August 7th, 2026. Remember, the soft landing only protects your quarterly updates, not your final declaration. And get your digital records started before your first quarter begins, not after. Subscribe to A1TaxFiler because next time I am covering exactly what goes into a quarterly update and how long it actually takes. Confirm where you stand, then get set up properly.